A zebra is designed to cooperate with other zebras, to mutualize, to come together into a herd of zebras rather than into individual zebras. A zebra recognizes, in some deep sense, that a business only has a social right to exist. Its social license to operate comes because society as a whole benefits from the existence of that business, not just the investors. And in that sense, the zebras are designed to live for a long time. Unicorns often don't.
Hello, and welcome to the fourth episode of this ongoing series of conversations about money and impact. My name is Carsten Terp. I'm the founder of the Danish impact media Impact Insider, and with me I have Graham Boyd, who is the author of a book called The Ergodic Investor and Entrepeneur. Graham, how are you this morning?
Hi, Carsten. I am full of energy, had a really good night's sleep, and very much looking forward to our conversation today about zebras and other animals in the startup and impact world zoo.
That sounds great. Actually, I can't brag with having had a good night's sleep. I was at a concert in Copenhagen yesterday with a British band called Nothing But Thieves. That has nothing to do with impact investors. I need to stress that. I just thought that you should know that if I look a bit tired and maybe sound a bit rusty, there's a reason to it.
Perfect, perfect. Well, I hope that you enjoyed your evening with the band. It's not one that I've heard of, but I will, after this conversation, head off and Google them and see what they're up to.
Great. No, there's a result of this conversation already then. So let's get on with it. Graham, you believe that we can get a lot more out of the money we invest in impact if we change the way we think about the economy. And that's basically what this series of conversations is about. Because if we mean what we say about pushing the world in the right direction as investors and entrepreneurs, we need to understand economics, and we need to understand it in a new way. So, Graham, last time we spoke, we had lions, we had springboks, we even had dung beetles on the agenda. But there are more animals on the impact savanna, and this time we're going to talk about the zebras. Now, everybody's heard about the unicorns, those rare high growth companies that every venture capitalist has wet dreams about. Zebras are distant cousins of the unicorns. They have a dual purpose, meaning that they strive to solve societal problems while making money at the same time. They focus on long-term and sustainable growth rather than short-term profit maximization. They value collaboration over competition, and they often work to include diverse groups of people. Actually, Graham, I think zebras sound a lot like Impact Insider. So, so tell me, seen from your perspective, why are the zebras interesting?
So I'll start by saying I think that the real question that we could be asking is, why are unicorns interesting? Because the zebra is really what business ought to be, always ought to have been, and in many senses is what commerce, marketplaces, trade, business always was. So much of the economy historically has contributed to the health, the integrity of the village, etc. If you go back sufficiently far in the past, in autumn, when the fields were being harvested, the miller might be out in the fields supporting the harvest. And then during winter, there might be farmers supporting the miller in what the miller was doing. So really, to my mind, the real question is, why do unicorns exist in the first place? And maybe I can start there, and then we can come back to zebras. So the reason why unicorns exist is because of the mistake deep inside economics that has carried on into modern portfolio theory and business planning. Yeah, and that is the mistake of neglecting the non-ergodic nature of financial capital. Yeah, and people who've read my book will recognize some of the figures. Actually, let me open up one of the figures. Shall I do that?
Please do.
Right. So what you're seeing here in these two graphs, the top graph is an example. It's a very simple illustration of what happens if you take 50 identical companies and you put them together into a normal portfolio, let's say a typical venture capital portfolio. And in this case, for illustration, I've set this simple illustration up for a target where the companies double in size every year, a very typical target growth rate in the venture capital space. And so each of these companies on a week by week basis, either they grow by 32.68% or they shrink by 30%. That gives on average a growth rate of 1.34% each week, or through compound growth, an expected doubling in size each year. And this kind of take the average over all of the probability and then compound that average growth rate out over a 5 or 10-year period is at the heart of business planning today. It's at the heart of economics, that assumption that you can take the average and then do the compounding. And what you're seeing in the top graph of how the capital of each of these 50 companies changes on a week by week basis over a 10-year period, what you see there is a very broad spread. And if you look up to, let's say, the 200th week, there are some of these companies that are actually doing really, really well. They've gone from $10,000 start capital up towards the $10,000 point. So they've grown in size 1,000 times over a 1.5 to 2 year period. Yeah, that's the kind of phenomenal growth that a venture capital investor will look at and say, this is superb. This is a business that has a founding team, a leadership team, staff that are really top notch. These are outperformers at the human dimension. Their product market fit is superb. Everything is absolutely fantastic. I'm going to keep putting more money into them. This is destined to become a unicorn. However, keep in mind what I said. Every single one of these companies is identical. The only difference between the companies that are outperforming, that are heading towards unicorn status, and the company that went bankrupt first after less than 2 years of existence, the only difference between those two companies is how often in the first 5 years did this 50-50 coin toss land heads where the company grew. There's no difference between any of these companies in terms of product market fit, quality of the team, or anything else. The only difference is just randomness. And to give you an example, let's say that I give 1,000 people a coin, and every time they toss heads, the person tossing heads stays in the game and gets, I say, $100. And every time they toss tails, they get kicked out of the game and they have to give back all of their winnings. So the first coin toss, 500 of the people will drop out. The second coin toss, 250 will drop out, half of the remaining. And so we can continue until eventually there may be just one person that is still in the game that has tossed heads, they will have tossed heads in sequence for every single play of the game. And the way human nature is, we invariably take that as evidence of this person has unique skills, unique gifts. They really know how to toss coins so that the coin lands heads. So what's behind this? Why investors have adopted a unicorn strategy is fundamentally because the human nature, the human intuition is not very good at understanding statistical processes. And even worse, in economics of today, that simplified, flawed understanding of what happens in this kind of statistical process when you're investing in companies, that's baked into the existing understanding of, from economics, of modern portfolio theory and business planning, that is exactly what venture capital funds, pretty much all investors, use to take their investment decisions. So the whole unicorn strategy is an attempt to correct for our misunderstanding of how capital grows in a business. And the essence of the unicorn strategy, I can sum up as saying the unicorn strategy is bet on a large number of companies, because sooner or later one of them is going to strike it lucky for long enough that if you exit at that point, you'll make back all of the money that you've lost on all of the other companies in your fund. So the unicorn strategy is nothing other than a strategy that depends on luck.
So it's like betting on a lottery ticket, hoping that it'll come out, and turning that lottery into a strategy, actually.
Yes, exactly. The whole unicorn strategy is so much like the strategy behind a lottery ticket.
So maybe you already answered this, but let me ask you anyway. Why are all these investors so dead set on this strategy as opposed to supporting zebras?
Yes. So there are a few reasons. First of all, a lot of it centers around human nature. Human beings, we love to attribute cause and effect to outcomes. And if you think of my example of 1,000 coin tosses, there is going to be one person that tosses heads 5, 10 times in a row and ends up as the last person standing and wins all of the money. Yeah, and we love to attribute that to, oh, this was a skilled, gifted coin tosser or entrepreneur or investor. Human nature does not like really situations where the true answer is, I just struck it lucky. I just happened to be the one person in 1,000 who tossed heads 7 times in a row and was the last person standing. We just don't like that. We love to see patterns. That's what our brains are designed for, is to see patterns. You know, after all, it's far better for us to falsely see the pattern of a tiger behind a bush that is about to leap out and ambush us than to not see that pattern. The other side of it is, let's also take into consideration that for that one person that strikes it lucky, that can be a life-changing thing. So a lot of people play the lottery, even though they know that most likely over the course of a lifetime, they will lose money rather than win money playing the lottery. There is a chance that they will win the lottery. And if they do, it will change their entire life for the rest of their life. So there actually is a logic to playing the lottery, because it might not cost you very much each week. It might just be the price of a cup of coffee. But if you win, it's transformational. And so that's also a valid part of this unicorn strategy. But the real thing behind it is most, if not all, of the people in the investment world, in the entrepreneurial world, have studied statistics at school or at university, have learned the kind of simple statistics that is taught there, the simple statistics that is embedded in much of economics and modern portfolio theory that does not take into account the non-ergodic nature of capital. And that statistics is designed to reinforce this flawed way of thinking. And so it's actually not anybody's fault, really. It's not the investor's fault. It's not the entrepreneur's fault. It looks, a unicorn strategy looks as if it is absolutely the right thing to do if we believe what economists tell us.
So what should we do to change that? What should we do to, no, let's start somewhere else. Let's take a look at these zebras, and then we can ask the other question afterwards. Because why would the zebras be interesting from an investor perspective?
Right. So let me start with what a zebra is. And a zebra is much more than what I'm about to say, but in essence, a zebra is a company that does not try to become a unicorn. It does not attempt to bring in massive amounts of investor capital in order to force growth. An investor says, I'm going to grow at an appropriate rate for my purpose. And my purpose is something that is embedded in what the whole world around me needs. A zebra is designed to cooperate with other zebras, to mutualize, to come together into a herd of zebras rather than into individual zebras. A zebra recognizes, in some deep sense, that a business only has a social right to exist. Its social license to operate comes because society as a whole benefits from the existence of that business, not just the investors. And in that sense, the zebras are designed to live for a long time. Unicorns often don't. Now, there was a study a while back, I think it was released in 2019 or 2020, looking at the valuation of the top 10 IPOs during the previous decade. And they found that of the top 10 IPOs, not one of them was trading above the IPO sale price. And so this is an indictment of the whole zebra mentality. The first investors got all of their money out during the IPO, during the exit, and then the companies lost value. That was not sustainable. That was an inflated value. Some investors get their money out because other investors come in and invest later. So the whole zebra is not necessarily designed to be a sustainable long-term company, and it's certainly not something that can do the job of impact regeneration, addressing the SDGs, building a society that is healthy and fit for humans to inhabit, let alone what we need is address all of the environmental challenges that threaten our capacity, our thriving as a human society in the future. That needs the zebras. That needs the camels, to bring in another animal in the zoo for later. It needs those, and that's why I say, in my perspective, the zebra, the camels, all of those are the natural way of building and running businesses, and the unicorns are an artifact.
So that makes me curious, because I mean, many venture capitalists, VC funds, are chasing that golden dream of the unicorn. Why? And that goes for impact investors as well, I'd say. Although there's a balance, of course, between profit and impact. But why would what would be interesting about the zebras from an investor point of view? Because you really want that company that does so well that your fortune simply skyrockets.
Yes. So let me start by speaking from the perception of for example, a company that is managing money on behalf of pension funds and the pension funds themselves. That investment is being used to maintain or at least or ideally grow the asset base of the pensioners. Let's say the pensioners in Denmark or the US or any country. And that money is going to be needed perhaps 10, 20, 30, 40, 50 years after it was invested. These investors absolutely need to have their investment going into companies that are going to pay back well when the pensioners need their money. Now, that obviously requires that the whole economy is doing well at that point. But this is where zebras have the potential to outperform any unicorn strategy when you're looking at it over a 10, 20, 30, 40, 50-year period. Because zebras are designed to cooperate, they're designed to mutualize, they're designed to work at the level of an entire economic ecosystem, and they can tap into efficiencies, possibilities to stay healthy, to stay alive, and to deliver solid, steady return on investment over a long period of time, precisely because they're not just focusing on maximizing short-term returns to investors, but are focusing on actually being a healthy part of a healthy economic ecosystem.
So over a long period of time, they're simply giving the investors a better return on their investment.
Yes, exactly. Over a long period of time, investing in a zebra ecosystem or a herd of zebras is more than likely to outperform the same money being put into a unicorn strategy.
Okay, but it seems that human nature stands in the way of doing the right thing here. How do we turn that around?
Yes. So, as you said, human nature stands in the way of doing the right thing. And this is so often the case. And I'm sure that if you think back into your past, certainly if I think back into my past, and probably everybody who's reading and watching this will recognize times where our nature stood in the way of doing what we knew was the wiser thing to do. Yeah. And certainly there are times where, for example, I have started collaborating with somebody because I really wanted what I thought they were bringing and didn't really do the due diligence that I needed to do to recognize, hang on, this is actually not somebody that you want to collaborate with. Yeah. And that's an example where every so often, well, always, we're looking at the world through a limited set of lenses. And sometimes those lenses lead us to do things like chase after a quick adrenaline fix or an easy route forwards or status, or in this case, believing what an authority figure tells us without really checking, are their statistics valid? In this case, I'm pointing at neoclassical economics. And well, everybody else is doing this. so I'd better do it as well.
So if I were running a zebra business and I would like to have an investor who actually understood this, I mean, are these investors out there at the moment? Where would I look?
So let me come to that in a moment, and I'll build an on-ramp to it. One of the key things that is very little known, even less known amongst the investor community, and still very little known amongst the zebra community, is at the start of the whole zebra movement, when Zebra Unite was founded by the founders of Zebra Unite, people like Astrid Schultz and so Astrid Schultz, Ania Williams, Mara Zepeda, Jennifer Brandel, when they started Zebras Unite, they were responding to the challenges they'd found in getting investments for their businesses, everything that was needed to get it going. And they were really clear that at the heart of a zebra strategy is mutualization, cooperation between zebras. Now, what's little known, and I'll come back to this diagram here, the real power in nature of a herd of zebras, the real power of nature as a whole, is what I could call hard cooperation, actually pooling profit. In nature, this is, as we've discussed previously, nature pools natural capital across the entire herd, across an entire ecosystem that includes zebras, lions, trees, grass, dung beetles, and everything. And if you look at the lower graph here, which is 50 identical companies now coming together as a herd, and where every company every week, if they make a profit, puts 2% of their profit into a central pool, and the pool is immediately divided out again to the entire herd. This is how an actual herd of zebras works. They pool resources. And you see the complete difference between this fractional profit pooling ergodic ecosystem approach versus a portfolio approach. By pooling just 2% of profit in this simple example, none of the 50 companies goes bankrupt. By the end of the 10-year period, all of the companies are still there. They're still progressing. Many of them have delivered a growth versus their starting point. And if we increased it to 3 or 4%, they would all be growing. If we increase the profit pooling to 10 or 20%, for example, the Mondragon Cooperative, which in many senses can be thought of as a herd of zebras, they have a 13% minimum profit pooling mechanism. Mondragon, during the 2008 recession, did not add one single person to the Spanish unemployment statistics, even though some of their companies went down, because the whole herd was the focus of their strategy, not just individual companies. So to answer your question, what's really needed is, first of all, for investors to start thinking that their job is not to invest in individual companies. It's to invest in the entire herd of zebras as one herd, to make sure that the herd that they're investing in, or the ecosystem they're investing in, is very diverse, where if there's a given event in the world, one of the companies might respond to that event by going down, but another company will respond to the very same context by going up. And then where that herd has fractional profit pooling, probably somewhere in the 5 to 20% level, where every month 5 to 20% of the profit goes into a pool that is distributed out again to all of the companies, which corrects for the harmful consequences of capital's non-ergodic behavior. And so what that means as well is a shift in mindset from the founders side as well, to think we really need to come together and found ecosystems of companies, not independent companies, which is also very hard and tricky to do from the governance perspective.
And from the investor's perspective, are the investors with this type of mindset, are they out there at the moment?
There are a few, very few. So in my conversation since writing the book, The Ergodic Investor, over a year ago and publishing it a year ago, I've had conversations with a few investors that get this. There are some investors that are playing in the big league, so that they do not invest in startups. They are running hedge funds. For example, the Universa hedge fund run by Mark Spitznagel with Nassim Taleb as co-founder. They fully get what I'm talking about. And they approach this not in the startup world with herds, as I'm pointing at, but rather as a hedge fund hedging against the extreme causes of loss. They completely get it. There are other investors out there who get this. Very few of the ones that I know of are investing in the startup world. And I think that's really the issue, is it's not too challenging to take the non-ergodic nature of capital into account when you're running a large hedge fund. It's much more difficult from a mentality perspective to get this to work in the startup world, because it requires, and this may tee us up for our next conversation, it requires the investors and the entrepreneurs to really look at this from an ecosystemic perspective, and it requires investing in a system. It requires investing in a systemic approach to investing that is fundamentally different to the current investment system, the current investment paradigm. And it's so different that you cannot simultaneously believe in the current system and the new system. There's no simple bridge or transition curve that goes from one to the other. It's like a kaleidoscope. You're either seeing one image or you're seeing the other image, and it's a sharp flip from the one to the other. And that's psychologically challenging to do.
Graham, I have a suspicion that you have peeked into my manuscript, because I was just about to say that this is what we have time for today, and I would very much like to talk about systemic investing for social change in our next conversation. Would you like that?
I would love that. I am very much looking forward to it, and the next 2 weeks can't go past fast enough for me.
Amazing. I look forward to it as well. Thank you for joining me today, Graham. And thank you everybody for watching. If you have questions for Graham, just send them to me on carsten@impactinsider.dk. Bye for now.
Wonderful. Thank you, Carsten. Bye for now.